Everyone seemed to be focused on the daily price volatility with this stock.
Right, the noise.
Exactly. We know the ticker closed at $186.50, down a little bit, and all the market chatter is just relentless. Is it overvalued? Is the AI boom over? It's all just price action.
And that's exactly what we're here to filter out for you, noise. Our mission today is really to dissect the Q3 fiscal 2026 results.
The actual numbers.
The actual numbers. We're going deep into the balance sheet and the income statement to understand the financial reality behind that staggering 93% year-over-year revenue growth.
And 93%. I mean, for a company this big, that's almost unprecedented. It's like it's defying financial gravity. We're going to look past all the emotional market reactions and see if the numbers really do back up this claim. That this isn't just success, it's a financial revolution. Okay, let's unpack this.
I think we have to start with the income statement. It tells the story of demand.
Yeah.
The raw power of Q3 is all right there in one number. Revenue at $57.01 billion.
$57 billion.
Just to put that into perspective for a second, that's almost double the revenue from the exact same time last year.
That one data point right there, it basically ends the debate about demand. Any concern that the sales cycle for their new chips for the Blackwell architecture is slowing down?
It's gone.
It's just not in the data. If anything, this suggests we're still, fully in the acceleration phase.
What's fascinating here is what they actually kept from that flood of revenue.
Right.
Because historically, when you see this kind of hyper growth, companies just sacrifice margin. They have to. They rush production, they pay more for supplies, or they offer big discounts to win market share.
But they didn't do that.
They did none of that. And that margin story is really what elevates this whole thing from just a successful company to that financial revolution idea.
Okay, so what are the numbers there?
The gross profit for Q3 was a phenomenal $41.85 billion.
Wow.
And when you run the math on that, it comes out to a gross margin of roughly 73% to 74%. Think about what that actually means.
74%, that's not just a good number. It basically rewrites the rules for hardware economics. It means for every single dollar of chips they sell, 74 cents is left over after covering the cost of making them. But I have to push back a little here. Is that sustainable? Is there any reason to believe this isn't just some temporary peak?
And that's the absolute critical question you have to ask. The data suggests this margin is, let's call it sticky.
Sticky, okay.
Because they're basically achieving software-level margins on a physical hardware product. Hardware is supposed to be heavy, capital-intensive.
And it becomes a commodity over time.
Exactly. But they're selling a proprietary mission-critical technology, these AI accelerators, that right now has no real scaled alternative. When you've cornered the market on the one thing that all the world's biggest companies have to buy, you set the price.
So that 74%, it's not just about efficiency. It's a direct measurement of their pricing power.
Yeah.
They're the only game in town.
Precisely. And that incredible efficiency just cascades right down the income statement to the bottom line. The net income for the quarter came in at $31.91 billion.
$31 billion.
So this is a business that's built to capture almost 3/4 of its revenue as gross profit, and then a huge chunk of that becomes pure net income.
And that figure, that net income, it really supports that dramatic claim we read in the analysis report that they're printing cash faster than they can spend it.
Yes.
Which leads us right to the other side of the story, doesn't it? The balance sheet. If the income statement is about momentum, the balance sheet must be about stability.
Structural stability.
Right.
And when we talk about a fortress balance sheet, what we really mean is immunity, resilience.
Yeah.
A fortress doesn't need outside help.
And the first line of defense is always cash.
Always. And the company is currently sitting on well over $30 billion in cash and cash equivalents.
$30 billion. Liquid. That gives them, almost unparalleled strategic flexibility. But in today's world, the debt matters just as much as the cash, right? Especially for you listening, watching the wider economy deal with inflation and high rates.
That's the crucial context. In a high interest rate environment, money is expensive for everyone else. This company, though, has extremely low leverage compared to its equity.
So they're basically debt immune.
That's a great way to put it. They're immune. They don't have to worry about servicing huge debts while the Fed keeps rates up. They don't need to borrow expensive money for R&D or expansion.
They just pay for it themselves.
They fund it all internally. And that translates into this massive competitive moat. While their competitors might be thinking twice about taking on new debt for a big project, this company is completely self-sufficient.
And they can play offense or defense with that capital without ever talking to a bank.
That is the very definition of a fortress. But to really see the freedom the management team has, we have to look at the king metric.
Free cash flow, FCF.
Yep. The cash that can actually be used.
So what does that look like?
When we look at the trailing 12 months, the TTM, the free cash flow number, is just staggering.
Yeah.
It's roughly $61.77 billion.
$61 billion.
And remember, that's the actual cash the business generates after paying for all the necessary capital expenses. Building new facilities, buying machinery, all of that is already paid for.
$61 billion of deployable cash in 1 year. That's more than some entire industries generate combined. So what can they actually do with that much FCF?
Well, it allows for a few different strategic plays at the same time. First, it's the ultimate floor under the stock price.
Right.
Even if the market gets rocky, this huge consistent cash flow supports the fundamental value. Second, it gives management a blank check. They can keep buying back stock, which reduces the share count and boosts earnings per share.
Or they can just acquire any new technology or IP that they see as a threat.
Or potential enhancement.
Okay. Yeah.
Or, they could raise their dividend. Right now it's tiny, 0.021%, but the capacity to raise it is obviously there.
But the big one has to be R&D.
It's the most important one. FCF of this size guarantees they can fund the future. These massive long-term R&D projects that they need to stay 2 steps ahead of everyone else. That's what future-proofs the whole business.
Okay, so we have insane growth, 93%. We have incredible margins, and a balance sheet with over $60 billion in annual free cash flow. This is where the fundamentals crash into market reality. The question is always valuation.
It's always the next conversation. You have to tackle the skepticism directly. The bears, they'll argue that the valuation is just too high. They point to the raw price-to-earnings ratio.
Which is what right now?
It's at 46.19 times.
46 times earnings. On the surface, that sounds expensive. It sounds like you're paying today for years and years of perfect growth. How do you even begin to justify that?
Well, if we connect this to the bigger picture, the sheer speed of their growth completely changes what expensive means.
Okay.
Most companies with a PE of 46 are, growing in the single digits? Maybe 15, 20% if they're having a great year. But for a company growing revenue at 93% year over year, that 46x starts to look, and this sounds crazy, but it starts to look cheap.
And this is why you have to look beyond a simple PE and use something like the PEG ratio, the price earnings to growth.
Exactly. The PEG ratio is the tool that puts valuation in context with speed. It asks, how much are you paying for each unit of growth? And because the G in that equation, the growth rate, is so massive here, the analysis concludes that when you adjust for that velocity, the company is actually fundamentally undervalued.
Undervalued?
You're getting this incredible growth engine at what is a pretty reasonable price relative to its expansion.
That completely reframes the whole discussion about the stock's current price action. We've seen it consolidating a bit. That's usually just the short-term traders, the weak hands taking small profits.
Meanwhile, the smart money isn't looking at this quarter. They're looking ahead to the next big catalyst.
And we know what that is.
We do. The catalyst is already defined. All this amazing revenue today is from the current generation, the Blackwell chips. But that massive FCF we talked about, it guarantees the next product cycle is already paid for and deep in development.
So tell us about that path forward. What's coming next that keeps this acceleration going?
The analysis report is very clear on this. The next architecture is codenamed Rubin.
Rubin.
And this isn't some minor update. It's their commitment to that 2-year high-volume chip cycle that the entire AI world now runs on. Companies that just spent billions on Blackwell are already planning their upgrades to Rubin. It's a revenue flywheel.
It's like an innovation treadmill, and they control the speed. And that forward-looking plan, it must be what's supporting the really audacious financial target we saw.
It is. The projection is a huge vote of confidence. The target is for revenue to hit $212 billion for the fiscal year.
$212 billion.
Oh, yeah. So when you put it all together, the efficiency, the fortress balance sheet, the tech lead with Rubin on the way, and that undervalued PEG ratio.
Yeah.
The conclusion from the analysis is pretty clear. The path of least resistance is UP.
Okay, so let's just quickly summarize the core of this deep dive for you. We looked right past the day-to-day price swings. We focused on the structural fundamentals, and we found a company with 93% revenue growth while also keeping these just astonishing 74% margins, a feat that really does redefine hardware economics.
We also found that fortress balance sheet. It's sitting on over $30 billion in cash and spinning off a massive $61.77 billion in free cash flow every year.
Yeah.
That gives them total immunity in this high-rate world.
The fundamentals, based on all the data, are just incredibly compelling. It's this rare mix of explosive growth, insane profitability, and just unshakable financial independence.
Right. And that leads to the final, bigger strategic question for you to really think about. You combine that projected $212 billion in revenue with the existing $61 billion in TTM free cash flow. What kind of long-term moves does that much financial power really allow?
Beyond just buybacks.
Far beyond that. We know they can fund Rubin, but could this kind of financial firepower lead to truly game-changing acquisitions in, say, completely different markets, moves that could reshape their entire competitive world, far beyond just making chips?
And figuring out what they do with that strategic power. That's what's going to define the next era of tech. That is where the real intrigue is. Thanks for diving deep with us.
Catch you next time.